We all have this image of Warren Buffett, right? The Oracle of Omaha, this investing wizard who just knows things other people don't. But what if that whole picture is completely backwards? What if his real genius isn't about what he picks, but about what he avoids? Just let that one sink in for a second. His massive success isn't built on some secret, complex formula. It's built on a disciplined refusal to make the same dumb mistakes that trip up almost everyone else. So that's what we're going to do today. Think of it like a wealth autopsy. We're going to dig into the 12 deadly mistakes that Buffett religiously avoids and that keep most investors from ever getting ahead. And I mean, this slide just nails the difference, doesn't it? On one side, you've got the herd. They're frantic, they're emotional, they're chasing the latest AI stock, and they're panic selling every time the market hiccups. And on the other side, the Oracle. What's he doing? Drinking a cherry Coke, waiting. It's this incredible contrast between chaotic activity and deliberate, calculated patience. So let's break down what that patience actually looks like.
Okay, let's dive into the first big category of mistakes. We'll call it the activity trap. This is the killer idea that to be a good investor, you have to constantly be doing something. Buying, selling, tweaking your portfolio. But honestly, that's usually where all the damage starts.
So what does that trap look like in practice? Well, it's these three big temptations. First, there's that constant itch to trade, just for the sake of it. Then you've got the shiny object problem, jumping on some hot new trend you really don't understand at all. And of course, there's that deep primal fear of missing out that pushes you to buy high and sell low right along with everyone else. And Buffett himself said it best, right? The whole game isn't about being the smartest person in the room. It's about being the most patient. The stock market is basically set up to reward people who can just sit on their hands while everyone else is running around in a panic. So how do you escape the trap? Well, first off, you gotta zoom out. Think in decades, not days. Seriously, if you wouldn't be comfortable owning a stock for 10 years, you shouldn't own it for 10 minutes. Second, stay in your lane. If you can't explain what the business does to a 10-year-old, you have no business owning it. And third, learn to go against the grain. Use the market's mood swings as your cue to do the exact opposite.
All right, so that's phase one. But here's the thing. Even if you stop the frantic doing, you've still got to fight a battle inside your own head. This next phase is all about the psychological biases that trick us into making truly terrible decisions.
And man, these are the classics, aren't they? There's the cigar butt idea, finding a junkie company that's so cheap you think, hey, there's got to be one last free puff in it. Spoiler, there usually isn't. Then there's listening to all the experts trying to predict the economy. It's a total guessing game. And finally, the one that really hurts, the anchor bias. That's when you cling to a losing stock just because you remember what you paid for it, hoping it'll magically come back. This quote is so important because it shows how Buffett himself changed his whole game. Early on, he was all about those cheap cigar butts. But he learned the hard way that it's way, way better to pay a fair price for a truly great business. Quality, he figured out, is the best bargain you can get.
So, the fix for this? It's all about rewiring your brain. You have to train yourself to hunt for amazing businesses first and worry about the price second. Then, you got to learn to tune out all the noise about interest rates and recessions and just focus on how the actual business is performing. And the toughest one? Get good at admitting you were wrong. Sell the loser and move on. As they say, the first step to getting out of a hole is to stop digging.
All right, we've wrestled with our actions and our own psychology. Now let's get into the nitty-gritty of how you actually build your portfolio. Because you can have the best mindset in the world, but if the foundation is cracked, the whole thing can come crashing down.
First up is the Noah's Ark mistake, this idea that you need to own two of everything. Buffett calls that diversification, and it's basically protection against your own ignorance. Second, and this is a big one, is the cardinal sin, using borrowed money to invest. And third is falling for a cool product, but completely ignoring whether the company has a real, durable competitive advantage, what Buffett famously calls a moat.
And listen, if you take one thing away about portfolio structure, let it be this. This is Buffett's big, flashing red light. Using leverage, borrowed money, is like pouring gasoline on a fire. Yeah, it can amplify your wins, but one wrong move, one bad day, and it can wipe you out completely. Game over.
So, how do you build a stronger structure? It's actually pretty straightforward. First, instead of spreading your money thin across 50 so-so ideas, concentrate your bets on your few truly great ideas. Second, and this is a hard and fast rule, never, ever borrow money to invest. And third, make that competitive moat a non-negotiable checklist item for any company you even consider buying.
Okay, this brings us to the final section, and honestly, this might be the most crucial one of all. We're talking about the silent killers. These aren't the obvious mistakes, like buying a bad stock. No, these are the subtle, invisible errors that quietly suck the life out of your returns over decades.
And what are they? Well, first, there's the sin of not doing something you should have, the great companies you let get away. Then there's the mistake of ignoring the people at the top, who's actually running the show. And finally, the biggest tragedy of all, interrupting the beautiful, magical power of compounding.
Okay, stop for a second, because this idea is huge. Buffett says, very openly, that his biggest financial blunders weren't the stocks he bought that went down. No, his biggest mistakes were the world-changing companies like Google and Amazon that he totally understood but just failed to pull the trigger on. It turns out, the cost of not buying a great company can be way, way higher than the cost of buying a bad one.
And look, if you think this is all just theory, check out this number. It's absolutely mind-blowing. 99% of Warren Buffett's net worth was earned after he turned 50. How is that even possible? It's the magic of compounding. It's a snowball rolling downhill. Every time you panic sell or chase some hot tip, you're not just losing money, you're forcing that snowball to start all over again from the top.
So, when you take a step back and you look at all of this, the frantic activity, the mind games, the broken portfolios, and these silent killers, it all boils down to one simple, powerful idea from Buffett.
He came up with this amazing mental model. He said, imagine that when you're born, you get a punch card with only 20 punches on it. And each time you make an investment decision, you have to use up one of those precious punches. You only get 20 for your entire life. Just really think about that for a second. If you only had 20 chances your whole life, would you still be day trading? Would you be buying that meme stock your buddy told you about? Of course not. You would wait and wait and wait patiently for an absolute no-brainer. You'd do massive amounts of homework. You'd think like you were buying the entire business, not just renting a stock ticker.
And really, that's what this is all about. That's the big lesson here. Investing is not a game you play. It's the slow, careful, deliberate process of buying pieces of wonderful businesses. And the moment you shift your entire mindset from being a player in a casino to being an owner of a business, every single one of these 12 mistakes, they just start to melt away.